Welcome back to the deep dive. So let me ask you something. Do you ever feel like you're, doing everything right with your money? You budget, you try to save, but somehow those big long-term wealth goals just they always feel out of reach.
hmm
Well, if that's you, then this deep dive is definitely for you. Today we're talking about something that's well, it's kind of insidious and silent, and it's probably happening to you right now without you even noticing.
We're calling it the invisible tax.
Exactly, the invisible
And it might
tax.
sound like some, abstract economic theory, but it is a very real, very measurable drain on your future wealth. We're diving deep into a whole stack of sources on this, all focused on how these tiny micro habits can completely destroy your macro wealth.
And our mission today is really to unpack those tiny, seemingly meaningless choices you make every single day.
The ones that when you add them all up, they amount to a kind of financial self-sabotage.
And I think it's crucial to say this up front. Our goal here isn't to preach deprivation. It's not about telling you to stop enjoying life.
No, not at all.
It's about eliminating unintentional leakage.
Exactly. The objective here is really twofold. First, we have to show you the shocking mathematical cost of this wealth leakage. And then second, we need to get into the psychology of it,
The why.
the why, the deep psychological drivers, the brain chemistry, really, that makes us willingly pay this tax. We want to help you shift from just, passively consuming to actively driving toward real financial freedom.
Okay, so let's get into it. And I think we have to start with the heaviest hitting argument first, which means we have to talk about the famous, or maybe infamous, latte factor.
Ah, the latte factor, everyone's favorite punching bag.
Right. Every personal finance talk seems to end up blaming your daily coffee for everything. But our sources, they offer a really illuminating reframe on this.
They do. And that's the key. The issue isn't the coffee itself.
Yeah.
I mean, if that $5 coffee brings you genuine, conscious joy and you've budgeted for it,
It's an intentional choice.
it's intentional spending. That's fine. The problem, this invisible tax, it only kicks in when it's unintentional. It's a habit you don't even think about anymore. The autopilot expense.
Okay, so let's look at the brutal math of that unintentional $5 daily expense. And maybe for you listening, it's not coffee. Maybe it's a quick lunch, a vending machine snack, or some in-app purchase.
It doesn't matter what it is. $5, 365 days a year.
That adds up to $1,825.
Right. And that amount alone, I mean, that's a decent vacation for a family. But that's actually not the shocking part. The really shocking part comes when we introduce a concept that is just central to this whole deep dive: opportunity cost.
Okay, that's a term that gets thrown around a lot. So for our listener, give us a really clear, punchy definition. What does opportunity cost actually mean here?
It's simple. Opportunity cost is not just the money you spent. It's the future wealth that money was capable of becoming.
Mm.
So if you spend $5, you're not just losing $5. You are losing all the potential future growth of that $5 if you had invested it instead. That's the invisible tax.
That makes the cost feel so much more visceral. So let's apply that. That $1,825 annual leak. Where should we assume this money would go if we plug the leak?
Well, we need a reliable historical benchmark. So our sources model this using a hypothetical investment in an S&P 500 index fund.
Okay, for anyone unfamiliar, what's up?
So the S&P 500, it just tracks the 500 biggest public companies in the U.S. It's used a lot in wealth modeling because you can buy a low-cost fund that tracks it. It's super diversified. And historically, it averages about an 8% annual return over the long term.
So we take our $5 a day, save it, and we put it into this reliable benchmark. Give us the numbers, because I think this is where the invisible tax stops being invisible.
And this is where it gets really devastating. Let's track this leak over 3 decades, right, which covers most people's prime wealth-building years. After just 10 years, that $5 daily habit has cost you $18,250 in cash. But because of compounding interest.
Where your money starts making its own money.
Exactly. Because of that, you haven't just lost the cash. You've actually sacrificed nearly $27,000 in potential wealth.
27,000. That's a significant number. But okay, 10 years maybe feels manageable. What happens if you, the listener, you keep that unintentional habit going for 30 years?
The numbers just explode. That $5 daily habit, compounded at 8% over 30 years, means you have lost over $200,000.
Wait, say that again?
Over $200,000. It is a staggering number, and people are often skeptical, but the math on exponential growth it's just undeniable.
$200,000 lost, Because of $5 a day. I mean, I have to challenge this a bit. Surely some people need that coffee to function, right? Or maybe that small treat is the one thing getting them through a tough work day.
And that's the core distinction. You're right. It goes back to intentionality. If you look at your budget and you consciously say, I'm allocating $5 for this necessary boost, that's fine.
Okay.
But what our sources find is that most people who leak $5 a day on one thing are also leaking $5 or $10 on a bunch of other things they don't value. Snacks, unused apps, impulse buys.
So it's not just one leak.
It's almost never just one. We're looking at multiple $5 leaks. When you combine them, that $200,000 figure actually starts to look conservative.
That is such a critical point. The math isn't attacking the one thing you love. It's targeting the sum of all the unexamined spending. And when you realize that $200,000 could be a down payment on a house or a huge chunk of your early retirement, it changes how you see that $5 purchase.
Instantly. The invisible tax is fundamentally a tax on inattention.
Okay, so the math is harsh. But understanding why we let this happen, that means we have to dive into the human brain. We need to shift gears from the numbers to the why. And this is where it gets really interesting. We have to talk about the psychological engine behind all this, what our sources call the dopamine loop.
Yeah, the problem is that our brains, fundamentally, they're not wired for 30-year compounding returns. They're wired for immediate reward, for survival.
Right now.
Right now. The sources really get into behavioral economics here. They explain we have this massive disconnect between our present self and our future self.
I've heard this before, that our brain basically sees our future self as a total stranger.
Precisely. The logical part of your brain, the prefrontal cortex that handles long-term planning, it just gets steamrolled by the emotional primal part, the limbic system, which demands an immediate reward.
So we go for the small, cheap things.
We gravitate toward them because they give us an instant, cheap hit of dopamine.
That fleeting pleasure of clicking buy now or getting that package delivered.
And that thrill is strongest when it's about novelty and immediacy. A $5 purchase gives you novelty right now. A $5 investment gives you a tiny theoretical gain 30 years from now.
The brain's not going to choose the 30-year option.
Almost never. So we are actively, even if it's subconsciously, trading long-term financial security for just 5 seconds of brain chemicals.
That is a staggering trade when you frame it like that. We're sacrificing $200,000 for a few seconds of cheap dopamine every single day. How do companies use this against us?
Oh, they make the friction to get the reward almost zero. One-click purchasing, buy now, pay later. The endless marketing of small, low-stakes items. It's all designed to activate that dopamine loop as quickly and cheaply as possible.
It reinforces the idea that, oh, it's only $10, it doesn't really count.
It's the psychological version of a tiny high-calorie snack. It's cheap, it's fast, it feels good for a second, but it's incredibly damaging over time. And this impulse habit, it sets the stage perfectly for the next big source of wealth leakage.
The subscription trap.
Exactly. The subscription trap.
Yeah, our next section is all about what the sources vividly call zombie money. This is wealth just marching out of your bank account without any conscious thought, and the subscription economy is the #1 culprit.
The data on this is genuinely shocking, mostly because of the gap between what we think we're spending and what we actually are.
Okay, lay it on me.
Researchers asked people how many monthly or annual subscriptions they thought they paid for.
Yeah.
Streaming, software, gym memberships, all that.
Right.
Most people, very confidently, guessed they had about 3.
3.
Yep.
Okay, that sounds manageable. I can probably list my 3 main services right now.
And that is the perception,
Mm-hmm.
the reality. The average person actually has 9 recurring subscriptions.
9. Wait, that's triple what people think.
Yeah.
I know for a fact I have at least 2 zombie services on my bank statement that I haven't touched in months.
And that difference between the 3 you think you have and the 9 you actually have, that is where the zombie money lives.
So that's the definition.
That's the definition. Money leaving your account for services you don't even remember signing up for, or that you stopped using 6 months ago, but just never got around to canceling.
We're talking about that VPN you downloaded for one trip, or that niche streaming service for one show, or the fitness app you opened once on New Year's Day.
Exactly. And the industry has gotten so good at maximizing this. They use subtle tactics, like offering a free trial that needs a credit card up front, or making the cancellation process deliberately confusing and hard to find.
Because they know that if the charges only say $9.99, it just slips under our radar. We don't scrutinize it like a $200 utility bill.
It's a death by 1,000 paper cuts, right on your monthly statement. I mean, if you just calculate the difference between the 3 subscriptions you thought you had and the 9 you actually have, you could easily be leaking $50 to $100 a month.
That's another $600 to $1,200 a year.
Yeah.
Just gone, not compounding for you.
And when you stack that on top of the daily $5 leak, the opportunity cost just grows exponentially. It all has to be addressed with conscious action, which, thankfully, brings us to the solutions part of our deep dive.
Okay, good. So if the problem is basically unintentional living or passive consumption, the solution has to be intentional living. And our sources really stress this is not about deprivation, which is a huge mental barrier for people.
And we really want to clarify the mindset shift here. The goal is not austerity. It's not about being miserable and denying yourself everything. Intentionality just means aligning your spending with what you truly value.
So instead of letting your wealth leak out on all these little micro purchases that just light up the dopamine loop for 5 seconds.
You stop the leak. You stop the leak so that you can consciously funnel that money toward things that actually matter to you. Well, if you truly value travel, that $200,000 you saved is the fuel for your travel fund. If you value freedom, it buys you years of early retirement. The mindset shift is realizing the power you get back when you stop paying the invisible tax.
That's a much more compelling way to look at it. It moves the whole conversation away from sacrifice and toward power. So if the solution is intentionality, we need an actionable step, something easy to implement. What's the one practical tool our sources recommend to interrupt that impulse and stop the zombie money?
The most practical, and it's surprisingly effective, is something called the 72-hour rule.
The 72-hour rule.
It just forces a pause, a cooling off period between the impulse and the transaction.
So lay out the mechanics for us. How does it work?
It's focused entirely on non-necessity smallish purchases. The rule is this. If you want to buy something under a certain threshold, let's say $100, and it is definitely not a necessity like groceries or rent, you have to wait 72 hours before you buy it.
So if I see some gadget or an online course or a piece of clothing I suddenly feel like I must have, I put it in my cart or I write it down and then I just walk away for 3 days.
That's the entire strategy. And that mandatory pause does 2 critical things. First, it drains all the emotional urgency that the dopamine loop needs to survive. You're starving the instant gratification monster.
Right.
Second, it forces the decision to move from your impulsive emotional brain to your rational logical brain. It turns an emotional whim into a conscious choice.
And what's the success rate on this? How often does it work?
The metric from the research is phenomenal. 90% of the time, the urge to buy will just pass completely within those 72 hours.
90%.
90%. The item loses its shine, the novelty wears off, and you realize you never actually needed it in the first place. You've saved the money, and crucially, you've protected your opportunity cost.
And if you still want it after 72 hours?
Then great. You've made an intentional purchase. It's probably something you genuinely value. This rule is a direct antidote to the unintentional living that fuels the entire invisible tax.
Okay, so to synthesize everything we've talked about, we know the staggering cost of opportunity cost, that a tiny daily leak can cost us over $200,000.
We understand the power of the dopamine loop, that it's trading our future for a 5-second chemical reward, and we recognize the drain of zombie money from all those forgotten subscriptions.
But the key is that the math that works against us when we're passive, it works exponentially for us when we're intentional. The invisible tax is only a tax you pay when you're not paying attention.
Well said.
So let's end with a final provocative thought for you, the listener. We know that $5 a day can cost you over $200,000 in lost opportunity over 30 years. So challenge yourself right now to identify where your biggest wealth leak actually is. Is it the coffee? Is it the impulsive Amazon buys? Or is it that combo of the 6 subscriptions you forgot about?
And then don't just focus on the loss. Focus on what you gain. What is the one deeply intentional thing, whether it's funding a trip around the world, buying a vacation home, or just the freedom to retire 5 years early? What could that $200,000 achieve for you?
Focus on that goal and start using that 72-hour rule today. We'll see you next time for the next deep dive.